Hello. Continuing our discussion for Chapter 6, we will continue what we had talked about in Chapter 5, which is internal control and risk assessment. So as I indicated to you, Chapters 1 and 2 explain the auditing profession. Chapters 5, 6, and 7 are about risk assessment before starting the actual audit, okay? Getting an understanding of the risks involved in this particular audit. Okay, so we are continuing that discussion further. Okay, we're going to talk about audit planning in this chapter, in the process for obtaining new clients. You know, every project, an audit essentially is a project, right? Every year you take a project of auditing a particular client and fulfilling that project. So when you start a project, as this says aptly, vision without action is a daydream. Action without vision is a nightmare. Okay, what we mean by that is any audit requires planning. If you have not planned for the audit, you don't have an audit plan prepared, you can fail the peer review. Okay, auditing firms are in the business of providing auditing services. Therefore, they would actively pursue new clients. What do we mean by that? Of course, you know, we as auditors are in this rather peculiar situation. We are supposed to be independent, okay? We do get paid from the client. So that in itself creates a situation which is a difficult or a precarious situation, to say the least. So like any other businesses, if there are no clients, there is no business. So we need to obtain clients to have our firm be in existence or stay in existence. Okay, anytime you get a offer or an interest in auditing, you need to submit your business proposal to the audit committee. Okay, fees need to be discussed. There needs to be clarity about fees and communication with the predecessor auditors to evaluate management integrity. Why did they leave? Were there any issues with their integrity? Okay, disagreements with management over accounting principles. The predecessor's understanding of reason for change of auditors and any other audit related issues. So for example, if the predecessor says, you know, we increased our fees and they were not willing to pay those fees, you know, maybe the predecessor audit firm is a big firm and they don't want to have those kind of clients and, you know, want to focus their resources on clients that pay higher fees. That's an acceptable explanation. Okay, maybe, you know, your firm is just growing and needs this kind of business, and that may be a right thing to do. But those are valid reasons why, you know, changes happen, and, you know, those are the kind of reasons why I have seen changes happening in small audit firms. Okay, but these things are not something why changes should happen. Okay, disagreements. That does not mean that you just don't accept the client. That simply means that you need to do your homework and need to understand why that happened. Okay, so when we accept new clients, we need to follow the process, right? Once you accept the client, audit planning. You fail the peer review if you do not have an audit planning memorandum prepared as to what you're going to do. Understanding of the client and its environment, including internal control. This is going to be redundant almost in every chapter that I'm going to be lecturing on. You will see that this line is there because it's the most important thing. As I mentioned to you, you know, all my life, if I have done, say, aviation industry audits like United Airlines and American Airlines, and then all of a sudden I'm shifted to a food industry, I may not know much about that industry. So what auditing firms do is if you start with aviation, you tend to stay in that. Okay, you do audit year after year, you gain a specialty in that, and then eventually you become an audit manager and then a partner and in that particular industry, and then hopefully bring more clients as you increase more contacts. Okay, of course aviation is a very restricted industry, but manufacturing, I should say, or, you know, the video industry or the food industry or that kind of stuff. The reason I said video industry is because when I was doing auditing, I did do in the video industry. So obtaining an understanding of the client and its environment, including internal control. Risk of misstatement and designing further audit procedures. Okay, what can go wrong? Based on that, you need to design procedures. Perform those procedures complete the audit, and form an opinion. This is the second section of this class, and this is the third section of this class. Okay, so those are the 6 steps that you need to follow while doing an audit. So let's discuss those steps. Plan the audit. Okay, talk to the client, prepare an engagement letter, come up with a strategy, a plan, discuss fees, all that stuff. Understanding of the client. Look at the industry journals. Talk to outside sources. Okay, do a risk assessment. Do some analytical procedures. Talk to management. What you're doing is you're trying to gain an understanding of the business and seeing what it is going to take to get the job done. How much work is going to be required in this. Of course, the more the amount of work, lousy internal control, more the amount of work, higher are your fees going to be. Okay? Assess risk of misstatements. Because of this risk, what can go wrong? Okay, financials, for example. I always like to use this because I've had this situation myself. The manager of accounts receivable does not understand the importance of recording simply as a collections guy and just keeps on, that is also important, but does not understand the accounting aspect of things, and so what can go wrong? Maybe the bad debt estimate he does not understand. Maybe write-offs he does not understand. Okay, if that's the issue, then how many of these receivables are really relevant? Okay, the aging schedules and proper procedures to follow that, he does not understand or she does not understand. Those are the kind of risks based on which you can tell yourself, what can really go wrong, how much work is going to be required. Further procedures, test of controls, analytical procedures, inspection, inquiry, observation, test of details. So let me explain to you, very important to understand this, okay? Test of controls versus test of details. So let me talk about test of controls. Test of controls means testing if the internal controls are working properly. Okay, try to sign on to any computer and you see that the computer requires password. Strong internal control. The warehouse is locked all the times. The safety deposit vault is locked. Okay, strong internal control. All right, employees need to punch in and punch out. Strong internal control over payroll. Okay. The HR department, when hiring, has a specific procedure for job requirements. Strong internal control. All these things means that the chances of something going wrong based on which the financial statement cannot be relied is then decreasing. Okay, so that's how you have got to look at it. Now, confirmation, calculation, report performance, and that's your test of controls. Now, based on this test, and I keep on saying this because you're going to see quite a few multiple choice questions on this throughout this class. If the controls are good, then the amount of testing is going to be less. Why? Because you can trust the environment. If the controls are bad, then the amount of testing is going to be huge. Why? Because you cannot trust this, and your sample size, for example, out of 1,000 accounts receivable invoices, okay, I want to test 100. That will be 10%. Now, because this is not good, I may take 20%. Or I may decide that I'm not comfortable. I may say, you know what, the accounts receivable department really is not doing the process correctly. What I'm going to do is I'm going to test all of these. I'm going to have to bring in 5 or 10 more people in, and I'm going to charge you more fees. Of course, these things can happen if you have not audited this client before. This is a new client. They don't know what's going on, and I've seen this, okay? And it's the first year that can happen. Next year, hopefully, when they have learned based on what you have told them, it should not happen again. Okay, and those are the kind of things. So more test of details because weaker controls. Less test of details because of stronger controls. Why? What is our ultimate objective here? Think about Chapter 5. Okay, AR equals, think about Chapter 5. AR equals IR times CR times DR. Okay, inherent risk times control risk times detection risk. These two are not in your hands. Now you found out that the situation is not very good. this has to be very low, so this can be under acceptable levels. So that's the logic that we are following behind that. Okay, and then finally you complete the audit. Okay, there are certain things you need to do: review minutes of the meetings, perform analytical procedures again at the beginning, during the process of the audit, and at the end again. You have got to do your analytical procedures, obtaining the representation letter and evaluating the findings, form an opinion, and issue the audit report. Okay, as I say, these two, section 3, test of details, section 2. Now, audit planning. Get a letter signed from the client. The letter should explain the requirements of the engagement, timing of the engagement, and clarification that staff support will be required. Here's a look at the engagement letter. Let's read the letter, okay, very clearly. So, I hope you have read it. Now, of course, when I say that, I'm stopping the lecture, which means you're going to pause as well and then read it so that you can understand better what I'm going to be talking about ahead. You have requested that we audit the financial statements of Keystone Computers and Networks Inc. Okay, what we're doing here is the scope of the audit and the objective. Objective is to audit, not to review, not to do limited procedures. Okay, we are accepting this audit. Okay, what will be your responsibility? Very important paragraph. Reasonable assurance, very clear, not absolute, not perfect, reasonable assurance. Any reasonable person with the right kind of skills would have come to the same conclusion that you did. It has to be conducted in accordance with GAS. Very well. Responsibilities of management. Very clearly, we will need access to all the information. Okay? Report will be who the report will be addressed to. There's no assurance over here that we will, and this is the important line. Circumstances may arise in which it is necessary for us to modify our opinion, add an emphasis, okay, which we'll learn in the later part of the chapter. Please sign and return the attached copy. And once you get the signed and attached copy, acknowledged on behalf by so-and-so, that means you're now ready to start the audit. Okay? And this thing is also very important, and that is going to be your own. Insert other information. Okay? So you can see name of the entity, management's responsibilities, and auditor's responsibilities are included in there. Why is this very important? Why is engagement? We just take templates, honestly, from the Thomson Reuters library, and because it covers everything that needs to be covered from a legal perspective. That's why these engagement letters are very important, because at the end of the day, if you're dragged to the court, you have to show through your work that you did everything that any reasonable auditor would have done. That's why these letters gain so much importance. Okay? Planning. Develop an overall strategy and an audit plan. Will you need the client staff? You need to say it up front. Will you need other CPAs? Will you need specialists? Okay, and first year audits communicate with the previous auditors. Okay? To plan the audit, it is necessary to gain an understanding of the client's nature of business. As you can see, redundancy. What would it include? Understanding client's competitive position. If it's a very competitive market and client is under a lot of pressure, there's a good chance of manipulation. Org structure. If there is not a proper chain of command, no checks and balances, risk increases. Educated people following, and when I say educated, meaning educated in accounting literate people following proper policies and procedures, decreases the risk, if not increases the risk. Okay? Aggressive management or not so aggressive management. Business model. Want to achieve so much in so little time. Very aggressive, very competent, or I should say not necessarily competent, in a competitive environment, very aggressive. Technological developments, okay, which means do people know how to run the systems that communicate the accounting information? Legal and political environment. One regulation in a tobacco industry can make or break a business. Very sensitive. Okay. Do they have budgets? Do they have proper evaluations for employees? Do they have strict quality controls? All these things make up your overall internal control, and once you understand that, you have had a good idea of the risks that are involved in this audit. Okay. Again, as I discussed in Chapter 5, with your trial balance, you start with analytical procedures, inquiries from outside, and legal analysts. As you find out, you will understand, okay, what is important, what is not important, things to look out for, things to not look out for. Because as you do all these things, you are gaining an understanding of the overall project and what you need to do to make sure that the project is going to be finished in the right manner. Okay, so that is important. Now, once you understand this, you need to decide what is important, what is not important. What do I mean by that? A cost-benefit analysis, right? The amount of work that you do and what you gain from that, okay, the cost should not exceed the benefits. You are providing a reasonable assurance, not absolute assurance. So some things may be material, some things may not be material. For example, $500 for a very small business can be a material amount, and for a big business like Motorola or United Airlines, $500,000 or less than that may not be material. So we need to assess that materiality. Your peer reviewer is going to make sure that you have assessed the materiality level. And here is the problem. I want you to read this problem first. Okay, so I hope you have now read this and understood the concept of materiality. The concept of materiality recognizes that some matters are important to the fair presentation of financial statements while others are not. The concept is basic to the audit because the audit report states that an audit is performed to obtain reasonable assurance. We're not trying to get absolute assurance, reasonable assurance. So some things may be more material, some things may not be. What we mean by material is that anything that can change the opinion of the investor in a way is material. Anything below that that cannot deviate the opinion of the investor is not material. The question may rise, and who decides that? You will decide that based on your judgment. Okay, that's what you're getting the fees for. What can change the opinion of the investors versus what cannot. So here I have taken problem 629 to take a look as an example. Here are two companies. One is a large company, one is a small company. And here are their numbers, okay? First, you will develop an estimate of the appropriate amount of planning materiality for Franklin. Then you will do the same for Tyler, okay? And describe misstatement that a small misstatement that might render it qualitatively material. We'll look at this later. But first, let's look at how I have also given you the solution. Rule of thumb, 5%, 10%, 0.5%, 1%, 0.5% of revenues, 1%. This may be you may have a spreadsheet or a chart where you just put these numbers in and automatically kicks out. That these are my numbers, okay? Now that you have these numbers, the auditors use the rule of thumb where they will use the amounts for any rule in such a manner as to function as a sliding scale in which materiality measure increases at less than a pro rata amount as entity size increases. What do we mean by all these things? Let's take a look at Franklin Company first. What might they consider relevant for this company? 5% of net income is 80,000, 0.5% of total assets, 0.5% of total revenue. Now, the smallest number in your range is 80,000. Okay, 0.5% of total assets is 174,500. 0.5% of total revenue is 148,000. So any number between 80,000 and 174,500 would be a reasonable range for materiality. You can pick a number from that between these two, and you may come up with something, an amount that is material. So what do we mean by that? Anything below that amount during your audit is not material, because you are trying to come up with a reasonable assurance. Okay? For a small company, they may use a higher percentage of the rule of thumb. And they may not use the net income, because the net income may really be less. Okay, and why? Because if you look at numbers below the range, you may be looking at almost everything, and the cost benefit factor may completely be violated. So that's why you have to take these things into account. So characteristics of a small misstatement that might render it qualitatively material include, but I'm sorry, I apologize, I just went one step further. When I look at this, we'll probably use the higher percentage of rules of thumb, so 1% of assets, 1% of total revenue. Okay, anything between this they may consider, because the numbers are small. All right, so this is a range based, and how do you pick it up? Based on your judgment. And how do you get judgment? Well, you get judgment with more and more experience. That is why when you start in auditing, you start at the bottom level, and then you go further and further and further into it, and then you become, you start as a grunt, then you become, a senior auditor or a staff auditor, senior auditor, and then you become a manager, and then hopefully your firm will give you partnership, or, you don't like the long hours, you may decide to move to, say, financial accounting or something like that. But that may happen. I've seen that happening. But people who love auditing, they just do auditing. Okay, and as I said, auditors are always in demand, always in demand. I like to say this, that in my career, I have never been without a job. And that's not because I'm just a great person or anything. That's not what I'm trying to say. What I am trying to tell you is that the profession that you are aspiring to be in has a high demand in the market. Everybody needs accountants, tax accountants, auditors, and financial accountants, managerial accountants. So you've chosen the right field, to stay focused, and you'll be there. Okay. Characteristics of a small misstatement that might render it qualitatively material include. What do I mean by all this? That look, sometimes there may come situations when, regardless of the range, some things may get your attention. So even if it is less than 80,000 in this particular case, or less than 27,000 in this particular case, there may be instances when you may still need to look at it and find out what's going on. Non-financial issues like a compliance. A very small difference may make a very small issue may make a difference between profit and loss. Okay. Objectives or goals may not be met. Precise measurements, and most important, profitability is unlawful transaction, management's integrity or compliance. In these kind of situations, materiality or the principle of materiality may not apply, and you may still want to look into it further regardless of the amount. But those things may not be, that often, but you also need to know that that may create an issue. Okay, so what is material, what is not material for your risk assessment? Understanding that is important. Now, once we have understood materiality, let's talk about the material misstatements. Now that we have done a risk assessment, what can go wrong? Okay, and what are the procedures for that? So let's take a look at that. Primarily, this area talks about what can go wrong, if it goes wrong, how big of a risk is there, okay, and what kind of an impact it can have on the financial statement. This can happen due to inherent risks caused by poor internal control or fraud. If it is a fraud, is it because of fraudulent reporting, or is it because of theft and stealing of assets? Okay, how can you detect that? Discussion among engagement team, inquiries of management and other personnel, your own judgment also is the way to assess fraud. Okay, analytical procedures and other factors. As I told you in chapter 5, when you go line by line, you look at balances and you start asking questions. Then you observe people, you talk to people, you find out what's going on, you start gaining an understanding of the company culture and company environment. These things start becoming more and more obvious to you. You know, one student in my life class joked and said essentially, so Prashant, you essentially mean we need to become Sherlock Holmes. And you know what? In a way, yes. As I always say, professional skepticism and the will to question is important. All right. SAS 99. What is SAS? Statement of Auditing Standards. 99 was written after Enron. It provides list of such factors organized around the 3 fundamental conditions necessary for the commission of fraud. We are talking about the fraud triangle. Okay. What kind of situations lead to fraud? Some type of incentive or pressure. Weakness in the internal control means that I have access to cash and I'm also recording the cash. No segregation of duties. Okay. Weakness. Incentive or pressure. Opportunity. So that what I told you is the second part. Incentive or pressure. My son is going to college. I need the monies. Okay. I have to, or I have a lot of debt. I need to pay off the debt. I need the monies. No internal control. I have access to cash and recording. And finally, an attitude to rationalize the act. My boss is a jerk. Let's take it, you know, in the best example I like to give is an example of my class. Pressure. I need to get an A in this class to transfer to DePaul. Opportunity to commit the fraud. My instructor gives the same exams to all the students in the class so I can cheat off my partner as opposed to my partner having a different exam. And rationalizing. The instructor is unreasonable, is too hard. You know, we all have our opinions about our bosses and our instructors and all that. And those are opinions. And there may be validity in some cases. In some cases, it may be raw emotions. But that does not mean that you cheat, right? So this happens everywhere. These 3 things is what constitutes a fraud triangle and what can lead to a fraud, okay? That's that example. And as I said, inquiries, alternate procedures. Okay. Shift timing to your end. Why? Very important question you'll see a lot of times. Whenever the risk is high, instead of doing testing all year long, you shift the entire test to the end of the year. Why? So that you can catch everything that you need to catch. Because if you do testing during the midst of the year, oh, this has already been tested. What if the fraud happens at the end of the year? Okay. So a lot of questions. If there's a higher risk, shift timing to year end. Important for multiple choice questions, okay? Professional skepticism, as I said. Do alternate procedures, surprise checkings, okay? Talk to people, and you will start finding if something's fishy, you know, in accounting, as I say, all the ends should tie in. What do I mean by that? Think of a short blanket when you are trying to, when you go to sleep, okay, and you try to wrap yourself with a blanket. If the blanket is short, you try to cover the head, the feet are exposed. You try to cover the feet, the head is exposed. All right? And that is so true in accounting because all the ends need to tie in. And many times during analytical procedures, you'll find ends don't tie in if that is the case. So that's what you got to remember with fraud risks. So risk assessment is what are the chances that can go wrong? Is there any fraud? Do we need to look for fraud? Those are the things that we need to be aware of. Conditions indicative of fraud. All right, let's take a quick look. I think the rest are self-explanatory as you read them, but let's focus on this. Inability to produce evidence. Okay, you need evidence because, you know, just like in the court, the judge goes by evidence. You will be asked to show evidence of your work, so you need to ask them for evidence. Last-minute adjustments. Very important. There's a lot of pressure. You know, the test of cutoffs that we talked about come into play. Last-minute adjustments are going to be very important. The rest is all self-explanatory, but I want to focus on this, denial. Now, what kind of pressure do you get? The kind of pressure you get is about, you know, I could go and I could get another auditor. You guys are asking too many questions. Maybe I should get your competitors in because they don't ask that many questions, kind of trying to make you feel guilty. If that happens, and that will happen, something's fishy. All right, and the human element never goes away, but based on your judgment what to push, what not to push, because at the end of the day it's your responsibility. Okay, so these things will come into play. Pressure will be put on you, not in all your clients, but one of those, one such situation, and then you will have some differences that need to be resolved. So you need to keep that in mind as well. Okay, designing further audit procedures. What do you mean by that? Let's take a quick look at this. Higher the risk, more work required. Higher the risk for a particular assertion may result in an increase, more test of details. Okay. Section 1. As you test more controls and you find they're good, less work for section 2. If section 1 is weak, when I say section, I mean the chapters covered in this class. Section 1 and section 2 is what I'm comparing. More the work, or stronger the controls, less the amount of work. Weaker the controls, more the amount of work. In staffing high-risk audit, the firm should consider experienced staff, specialized skills, and the extent of supervision. Okay? Because of course, experienced people will give you better results. And you may need, in some kind of cases like auditing diamonds or auditing specialized industries, you may need that. Okay, so you need to keep that in mind as well. Now, as we move on to the second part, this is very important to understand, and I would say this concept is probably one of the most important concepts of this chapter. So, I would drop my pencils and everything and just pay attention over here as I try to explain to you this concept. Okay? All right, let's get started. Okay. Cradle to grave, grave to cradle. Again, cradle to grave, grave to cradle. Test of existence versus test of completeness. For test of existence, you go from grave to cradle, reverse. Okay. Possible overstatements, revenue and assets. Okay. You go reverse. Possible understatements, liabilities and expenses, you go in the correct order. Why do you go in reverse over here? Think about this. Go into the ledgers or the financial statements, pick out, for existence, my revenue is made up of so many receivables. Give me 50 to 100 invoices, and then I'm going to go reverse. I'm going to see when these invoices were prepared by journal entries, what kind of sales orders and source documents you have. I'm going reverse, okay? Because I want to make sure that these invoices do exist. Completeness. This way. Understatements. You start here, you end here, okay? I want to make sure, let me look at all your purchase orders, okay, and let me see, or your payments, and let me see that you have recorded them and recorded them in the correct period, okay. Here the intent is to overstate the net income by increasing revenues. Here the intent is to overstate the net income by showing less expenses. So again, grave to cradle, existence, cradle to grave, completeness. From ledgers to source documents is existence. From source documents to ledger is completeness. All right. Am I going to see a lot of questions on this? You bet. Am I going to see a lot of questions throughout this course on this concept? Absolutely. Are you going to see a lot of questions on this in the CPA exam? No doubt about it. Important concept. Please understand this and understand it clearly. Okay. So, cradle to grave, grave to the cradle. For what purposes? For the audit trail. Now, moving on, the audit program can be divided into two parts. Test of controls, test of details. And I already mentioned this to you before, But as you can see, some of these concepts, you may feel they are redundant. I'm explaining them again and again. Reinforcement in this class to help you build your judgment is very important. Okay, so understanding the industry, lot of redundancy. Test of details, test of controls, lot of redundancy. Okay, test of controls, how good are the controls? Test of balances, test of details. Based on this, you will do this. Based on the first test, auditors will make necessary adjustments to the second test. Okay, so you'll see multiple choice questions on this as well. Weak internal control, I'd highlight this. If I were you, would lead to heavy substantial testing and vice versa. Strong controls may lead the auditors to decide to perform less extensive procedures, okay? Because think about this, year after year you are auditing this client. This client knows what you're going to look at. You have found that, the overall internal control, meaning you have the right educated people over here. They want to do the right thing. You have made your assessment. Year after year you're coming in. They know what you're going to look for. They have it ready for you. They have nothing to hide. You ask questions. There hasn't been a significant amount of turnover in this company. It's going to have an impact on your test of details. Okay, because you know them, they know you, they know what you're looking for, and the work goes in a smooth way. Less fees for them too. They too have a benefit over here, because of course if you're going to spend more time, you're going to charge more fees. Okay, finally, let's talk about what kind of accounts we audit. Okay, primarily we audit the balance sheet accounts. Because when you audit balance sheet accounts, you're looking at huge balances and you're asking questions which will then also relate to income statement accounts. So when you audit balance sheet accounts, you're also indirectly verifying income statement accounts. Now, changes in assets and liability accounts indirectly verify revenue, cost of goods sold, and expenses. Most revenue transactions debit to cash or accounts receivable. So if you look at accounts receivable, you may also be looking at revenue. Very important. If you know cash and accounts receivable is accurate, there's a good chance revenue is accurate because what other ways could you be looking at revenue? Okay. Of course, does that mean that you will never ever look at the revenue account completely? No, you would browse through it. But the testing part, as you do this more and more of this, it'll make sense, because where are you going to book the other side for revenue besides cash and accounts receivable? Think about it. If there's any other side you're trying to do fishy, you'll be able to catch that when you do the other audits for the other things on the balance sheet. And then there is direct verification. What do we mean by direct verification? Certain accounts such as revenue are of such significance auditors virtually obtain direct evidence. So, am I trying to contradict myself over here? No. If the revenue is so large, okay, you may decide that yes, I want to do indirect, but I also want to do direct verification. If it's a small business, not that many transactions, you may decide not to do direct verification because indirect verification is already happening. All right, and here is the balance sheet items. Here are the income statement items. Cost of goods sold. When you do inventory, you're doing cost of goods sold. Okay, when you are doing liabilities, in a way you're also checking inventory. My fault. Interest expense. When you're doing property, plant, and equipment, you're also looking at depreciation expense. So they may get substantiated by all the balance sheet accounts that you're looking at. So that's the difference between direct verification and indirect verification, which you also need to understand. So once you look at this, then you know the audit objectives. What do I mean by that? When you do a risk assessment and you know what the total risk, how much is the risk involved, that's when you start coming up with your objectives. Okay? You need to meet certain objectives. And the audit program is a program that tells you the objectives and how you're going to meet those objectives. What are those objectives? Take a look. Do all these assets exist? Look at receivables. Do they have right to these assets? Look at loan covenant statements. Look at receivable statements. Okay? Have all receivables been recorded due to an error? Cradle to grave. Cut off transactions. Cradle to grave. To find out that they have been recorded in the right period. But that's your objective. Valuations. Bad debt expense. Has bad debt expense been properly recognized? If not, maybe the receivables are actually overstated because they don't have that many receivables. Financial statement presentation of assets. Receivables are properly presented in the balance sheet with proper disclosures. Okay, all these things are important. Each and every objective, what you may do to make sure that objective is met. Okay, what can go wrong, and the procedures. So I would read this to gain a better understanding of what my objectives are, because I don't know what my objectives will be. Of course, you have a basic template that you will go through that we all understand, but you need to do a risk assessment to find out those risk areas where you may need to do more and more testing based on risk of material misstatement. What can go wrong? So for that, you may need to read this part. Okay, so again, I'd read the chapter, I would do the workbook multiple choice questions, and then move in the same order that I have always asked you to move in. Okay, thank you.